People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers, a show where we sit down here and talk about you and your money. We talk about your 401k and all the things that you're doing right now to get ready for that thing called retirement. There's a day when you're going to walk away from that employer paycheck, and then all of a sudden it gets real. It gets real because what you live on is what you've saved, and how do you make that last? That's what we talk about here on the show. Charisse, how are you doing today?
You know, I'm feeling a little sore.
Uh-oh.
I wasn't going to share this on radio.
You
but
out climbing mountains again, or what are you doing?
No. Okay, so it was the first weekend in months. Me and the kids got to lay low. We didn't have any major plans. And my garage, I had the floors painted, the roof painted. I tried to make it a really clean looking garage.
Okay.
And so it's been months. And, you know, the golf carts leak. And I had to move some stuff in and out. And I'm starting to see stains on the blue floor I have in my garage. And so I was like, you know what? I'm going to get out in my garage and get the kids out there, and I'm going to hose this 3-car garage down, and then I'm going to wash it down. So when I realized I was going to wash it down, I didn't have a brush. So I took 2 towels and literally did the wax on, wax off with my legs for the whole garage. The kids only helped me for about 40 minutes. But I'm telling you, my garage looks beautiful. And then I was like, well, I got to get all the dust and all the stuff off the windowsill. So I went all the way around this garage like it was inside my house. But I'm going to tell you, my garage is clean.
I guess
and
so.
a lot of people, I had a friend's like, why didn't you just have somebody paid to do it? I'm like, I don't know. It just felt good to get dirty and get in there and sweat. So that's what I did. And I'm sore.
Wax on, wax off with your legs. Okay. All righty then.
Anyways. And the floor is clean. My kids are like, I can't tell the difference. I'm like, yeah, but I can.
All right. Talk to me about you do client events and you get out there with your clients. You do educational events, things like that. You did a movie review the other day.
We did a movie premiere. Okay. We do it every year, beginning or end of summer. And it's so much fun. We do, food, tons of gifts and prizes, pictures. And it's interesting because we had rave reviews from this one compared to last year. Because last year we picked the wrong one.
Uh-oh.
It was like I think it was the Joker last year. We didn't know how awful it was going to be. This one was great. But I had some clients who came in after for their reviews this week. And, one of them said, Charisse, you always talk about, and you're really proud of your customer service, but do you know you give the customer an experience? They're like, the customer experience, is something where what we perceive of you and your team. And it's like, you guys don't skip a beat. And we just enjoy coming to these events. And it made me feel so good because we weren't always great at it. And, I think over the last 3 to 5 years, we've gotten better, and we're about to get even better because we're even making that a whole nother level of an experience. But it was just nice. And we had a good time and lots of hugs and lots of pictures.
Love it.
Yeah.
It's when you come to Zinnia Wealth, it is like a family, and it is something that it's not where you walk in the door and you sit down with Charisse or the team and you build a retirement plan and then you shake hands and you wave goodbye and that's the end of it. That's just not the idea here. We want to support you through retirement. We want to get you into retirement and through retirement, and that's the whole idea. And that means you're part of what we do here. So we appreciate you listening, and we appreciate you taking part in all that we do at Zinnia Wealth. And we're going to start the show today with an interesting question. I found this in Kiplinger, and I know that I'm just going to set you loose on this because the question is, if the market goes down or flat, should I back off on my withdrawals?
How do I want to enter that? All right.
Without getting too excited. Okay.
I know. No, you're in retirement. No way, no how should you be backing off your withdrawal plan so that you can do your trips every year and go do whatever you need to do, right? And so when I hear this, it just means that a portfolio might not be generating as much income as it should. And if a portfolio is not generating as much income as it should, and it's just in a 60-40, it's just in this growth phase, then that also tells me there's not a written plan. And Randy, we've talked about this over and over again. 1 out of 5 retirees or pre-retirees have a written plan. And so not in our office, everyone has one here. And with that written plan, it shows the income strategy, because the growth strategy is over, you guys. You went from accumulation to now we're retired or prepping for retirement. We're going to decumulation. But let me add, it doesn't mean we're not going to have growth. It's just a different kind of growth while taking these withdrawals and taking income. And so income makes the world go round, and everybody should have 4 to 5 different paychecks coming from 4 to 5 different sources doing 4 to 5 different things. It's that simple. It's not a complex thing, but it is a withdrawal strategy where a lot of people don't know how to do that. If you're retiring, you're probably not going to be able to figure it out on your own. If you're an advisor, you probably don't have a clue what I'm talking about, because it's a specialty that we focus on here. And income, if you don't have income checks coming in and you're peeling off this mound of money, I understand why maybe you're feeling insecure about the plan or you don't understand the plan. And when the market goes down, you're wondering, why should I stop taking money out now the markets go down? Because you've been taught your whole life, when the market goes down, do not sell.
Don't sell, right.
So now you're in retirement, the market goes down, and you've been selling while the market goes up, and you're getting your income. You're like, oh, this is great, and my accounts are growing, yay. But now the market, if it goes down, and you know that financial conventional wisdom that you've been taught for 30 or 40 years, and now you're questioning it, is because you don't understand your plan, bottom line, and therefore you haven't been given a real plan.
Well, we talk about this a lot. Your retirement should not be determined by a stock market. It should not be determined by the economy. It should not be determined by inflation. It should not be determined by all these things. It should be determined by the income that's coming in, and that you build ahead of time. And I mean, the spending that we have in retirement is going to vary. I mean, I know that you probably talk to people who are in their late 50s, early 60s, mid 60s. They get going into retirement. They go off and you get your emails and your pictures on Facebook from their great trips and everything. And then all of a sudden, some of that stuff, it starts to taper off a little bit. And you've done what you want to do. And I mean, spending in retirement kind of goes in phases, doesn't it, Therese?
Spending in retirement absolutely goes in phases. And where the biggest mistake happens is that first phase, your go-go years, you've just retired. That is a phase that you have permission to spend your money, spend more money than you intended. But how are you going to be able to figure that out if you don't see the plan and you don't see it working for you? And your first 10 years is going to be your healthiest. I'm a broken record. I say it all the time. And spend more while you can, while you feel like it, why you still have the energy and you got that go-go in you, because eventually you're going to turn 75. And if it's not sooner, maybe a little bit later, it could be sooner, you're going to start to feel the no-go. You're going to wake up, things are going to hurt a little bit more. I have this client, and she and her husband are the ones that got me to build this office in the Villages. They even picked out my location, and they give me so much advice, and they're fantastic. I love them to death. And one thing they said to me, they came in this week. They only come in once a year. That's all they call for. And they said, Therese, you talk about all this stuff and you get us ready, but nobody talks about the day you turn 75 or somewhere close to it. What is next? And it's interesting because they have slowed down. They're slowed down sooner than I thought they were going to slow down, believe it or not, because they were high energy, high impact. They communicated with me saying, we are skipping steps. I feel like we've skipped this step. I can't do as much. And her husband, she's 75, her husband's 80, and he's been racing bikes since a year ago till he got injured.
Wow.
And he doesn't even look 80. It's crazy to me, but I can see it in his eyes. I can see it in his posture, and he's skipped a step. And we talked about that. And he's like, so what's this next phase going to be like? Because nobody's teaching us or educating us about this. And he's like, it seems like every year something new is happening with my health that I didn't really think about. And so I had to sit down and really just have this conversation with him. And I said, well, think about it. I'm 47 years old. Do you remember when you came in? I was 40 and you told me I was going to have bunions by the time I'm 50 if I don't lower my high heels. They're like, yeah, I remember. I mean, all of my clients have said that. So I now I wear tennis shoes more often. But I said, I'm growing with you guys. And I've seen a big change in even my life from 40 to 47. And I said, so I feel for you guys because I'm watching it happen to a lot of my clients that were 65 that are now turning 75. And I'm seeing it more and more and more. So I'm like, there is a story to be told. So I want to share that story. And that story to me is spend your dang money when you retire. So because when you hit this phase and you don't want to go on a cruise or you're afraid to get off a ship in Alaska because of something or another, there's just a health issue, then you're not spending the money.
Yeah.
Right. And so I just think it's important to understand there are phases of life, because then you go through the slow go time period and then we're not spending money. You're saving again. So those portfolios are actually starting to get built up again. But then there becomes the period where healthcare arises, where you really do need some stuff done. And it could be 5 years from that point. It could be 10 years from that point where you're starting to spend chunks of money. So that has to be built into your written plan in case you are eroding your portfolios for care and nursing home duties, somebody coming in, or you go into a nursing home, because you want to make sure there's money left over for the surviving spouse if something happens. So I know you're like thinking, hey, well, if I spend more, then how am I going to make sure there's money for nursing care for me and my spouse so my kids aren't like stuck with this? This is why you need a written plan, so I can show you.
Give us a call. Let's sit down and talk about your spending in retirement. It's going to be back and forth. It's going to go year to year. It's going to go kind of like a smile, as we say. A lot at the beginning, and then it goes down, and then it goes back up again. Let's build a plan so that there's the income there no matter what the markets and the economy and the inflation are doing. Here's our number and our website. We'll do what is called a complimentary retirement consultation. That's a big term for it's a free meeting. We're going to sit down and talk about you and your money. If you go to our website, there's a gold box there, zinniawealth.com, ZINNIA wealth.com. There's a gold box that says complimentary retirement consultation. Click on that. It's a no cost, no obligation meeting just to sit down and get to know you and talk about what you're concerned about. You can also call us at 833-368-3680. Again, 833-368-3680. Well, we've talked about peak 65 in the past. There are more people turning 65 this year than any other year. So you would probably figure that there are more people filing for Social Security over and over and over again. And yes, this year, 276,000 more people filed for Social Security than last year. But not all of them are waiting to the age of 65. They're waiting to the age of 62.
That's probably my fault.
I don't know. So I wanted to ask you about that. What is your thoughts and process when somebody comes in and asks that simple, important question? Sharice, when should we file for Social Security? What is that decision based on?
Yeah, number one, that's one of the biggest questions people come in, because there's a lot of noise out there, a lot of information, and they just think, hey, both of us should wait till 70. Some people say, no, we should both take our income. If you're married, take it at 62. And so this goes back to that written plan. When we build that out, we're going to show you, hey, what if one of you take it at 62, the other one takes it at 67? Or let's say we didn't save enough. We're like, let's go ahead and get one of you to take it at 62, another one waits to 70, if we can do it. So we're playing around with numbers all the time. But I do advise one person typically to go ahead and take it at 62, because if one of you don't live to 80, that's a lost income. That is not a legacy in the future. You're not going to get it, right? And so there's been some situations where it was more about, hey, why don't we both take Social Security, Sharice, at 62? It's not going to make or break us, not going to change anything, but it leaves a bigger legacy to our families when we pass away, because we're not having to erode the 401k. So for legacy purposes, sometimes when we build this income plan, it actually does make sense to take it at 62. Like I would say 1 out of 5 people, sometimes 2 out of 5 people, depending on what are your goals at the end of the day. And if you're somebody that says, I don't want to leave a legacy, that's going to be a different strategy. The income plan is going to look a little bit different. But it also has something to do with tax strategy. So if you're looking at claiming Social Security and leaving a tax-free legacy to your surviving spouse or even your kids, that's another strategy when we're deciding on when to take Social Security or not. We are in a great time period right now with these new rules that change. And if you're 65 and older and collecting Social Security, you and your spouse get $6,000 a piece. So we've actually changed our strategies based on this extra write-off our clients get. So again, leaping ahead, thinking forward, we can't change the political climate. Geopolitical risk is out there, but we have some benefits right now because of geopolitical risk. So it's in our favor right now to maybe collect Social Security, even though those provisions fall off in 2028. It's a good time to take advantage of it. So when you're claiming Social Security, it is not cookie cutter. And I'm going to tell you, a doctor of mine years ago came in and said, Charisse, I think you're wrong. I think I should take Social Security now. And because we had some income checks built in, we're going to turn them on. And it was interesting because she put me to the test. She re-stress tested my plan. And you know what? At the end of the day, I was like, you know what? For her and her family, it didn't matter if they collected at 62 or 67. So we ended up collecting at 62 for them because we were able to do something else with the asset that she wanted to do in a different direction. So, making sure we do the math on that is very critical. And then we had to live long enough, everyone. Remember that. There's no guarantee there.
Yeah, I did my numbers, and it didn't make sense to wait till 70. Mine says, when you get to full retirement age, that's probably best for you right there. So, I mean, it for everybody, it's not the same. It doesn't mean, I know, the longer you wait, the bigger the check. We know that. Yeah, but it's not right for everybody to wait till 70. It's worth sitting down and having a conversation. And
what if you die?
And doing the math. Yeah,
what
exactly.
If you die?
Exactly.
You wait until 70, you die at 60. You get a whopping $250 check to the beneficiary. They don't get, you lose. Somebody loses along the line. So
you can't pass along Social Security.
No.
You
so
can.
COVID changed a lot of things.
You can pass along your 401k, as they say. All right. Well, that's part of the conversation. Maybe that's the big thing you were worried about and you want to get answered. Let's get you the answer. It's going to take a little math. Let's figure it out. 833-368-3680. 833-368-3680. Or use our website, zinniawealth.com, ZINNIA wealth.com. Gold box there. It says complimentary retirement consultation. Click on that. You'll be on your way. Okay, so somebody writes into the Market Watch advice column, and he said this, and this is the only part of I'm going to tell you. He says, I spend 5 hours a day on my portfolio.
I'll spit out my water. Good gracious.
So somebody walks in, they listen to our radio show, and they get an appointment, and they sit down with you, and you're on the other side of the desk, and that's the first thing that comes out of their mouth. What do you say?
Out. Just kidding. No. Well, number one, this is a unique individual. They're either not working and not retired, and they have the time, and or they're just really good at it.
Yeah.
And or number three, they just like doing it.
Yeah.
Right. And that's just their thing. I've met people like that before. And it's okay if that's your thing. We have clients that still want to hold on to some of the reins, and we let you. Yeah. And then we manage the difference. And when you're tired of holding on to the reins, we're here to manage the rest. I mean, this happens a lot. But, my question is, do you really want to do that every day? And the people that I find that do that, eventually, it usually takes 12 months, sometimes 24 months, where they're just like, I'm over this. Your returns are beating my returns. And you can have this. Or sometimes their returns, I had two clients where their returns were slightly higher than ours, but they're like, I really just don't want to do this anymore. Yeah. You're doing great. I'm like, do I really need a couple of percentage points more? No, I'm not going to, run out of money. We're still growing. And so there becomes reasoning of why I'm in retirement and what I really need to do, happy wife, happy life. And you have no idea how many people come in and the spouse is like, I don't want them managing the money anymore, or at least need them to be shooting off the hip with you because I'm not sure they're overexposed and we want to make sure our money's here. So there's a lot of types of reasons why we're seeing those types of people, but it's okay if you're good at it. We want you to be good at it. If it keeps your brain ticking and alive, but I hope you're sharing your time and enjoying retirement in other ways.
What about the idea of this? You mentioned the couple. So let's say it's the guy who's doing all this, and the wife comes to the meeting, and she's just over there looking at her phone going, this is his thing. Don't worry, I let him do that. Someday he might not be there. And if he's spending 5 hours a day tinkering with this thing, do you expect your wife to spend 5 hours a day doing the same? No.
Yes. And that is why that individual is in my office, because they realize it. They don't want to admit it, but they have come into my office to sit with us because they're like, okay, I'm good at this. My wife She doesn't want anything to do with it. So I need my wife to like somebody that she can trust and that I trust, and I can watch them doing what they're doing so that when I do pass away, I know she's in good hands.
Yeah.
We get so many people just for that in our office. And the guys out there like me and the women in our office because they really want a female to be working with their wife, because all women, most of us are mother gooses out there, and they know a woman's going to take care of a woman, right? A woman's still going to take care of a man in this industry, but men know men.
There's a little...
And those men don't want their wife to be with another financial advisor that's a man, which I think is incredible. And I learned over time, I'm like, oh, right time, right place for me then.
There is some mama bear happening over at Zinnia Wealth. I can tell you that for a fact. You know,
we protect our ladies for sure.
The other thing that jumps out at me on this is, and I only gave you the very first line of this, I spend 5 hours a day working on my portfolio, but here are my questions, and then bum, bum, bum. So even though he spends 5 hours a day on his portfolio, he still has questions. And I wonder what he's missing. If it's all about markets up and down and day trading and doing that kind of thing and trying to beat the market, okay. But are you thinking about taxes? Are you thinking about legacy? Are you thinking about Social Security? Are you thinking about Medicare? Or is your entire focus on this one part of retirement planning and you're missing some of the obvious?
You let me manage your money, and I'll show you how to save hundreds of thousands of millions of dollars and your legacy passed on to that surviving spouse and your kids. Tell me you can beat that return. And you can't. You can't. Try me. We're that good at that. And we forget that moving part. That's just the tax part. Yeah. I'm talking about the Medicare part and the Social Security part. And then we have the elder planning part, how to get ready for that, because don't go buy a John Hancock or Genworth plan. There are other things that are probably a little bit better for you, and most people can self-pay themselves. So there's so much out there, and I want to save you money. And if we can save you money against Uncle Sam, we're going to.
Well, one of the things about this show that we say, hey, if you are a do-it-yourselfer, come on in. Let's see how we can help. If you are a person with a clean slate and you don't know where to go with this, come on in. Let's see if we can help you. I mean, I know that over the years that we've been doing the show, that you have taken people from one end of this scale to the other, people who have no knowledge, people who are, probably day traders, and you can find a place for them with some retirement planning.
You can. And a lot of times these guys who are doing it on their own, not only do they want their wife to be okay if something happens to them, but they've just realized they had a misstep somewhere. We talked about that earlier with another client.
Yeah.
They're 75. They just feel like they're misstepping, and they can feel it and they can tell. That happens to men also and women. And when it comes to managing money, they start to lose confidence. And then they're just like, gosh, there's more to life than sitting here for a couple hours here and there. And then they kind of wake up and they smell the coffee. They're like, oh, this is what Sharice has been talking about.
You and I, we've done that show about cognitive decline. This is going to happen. I mean, the math and everything like that, you get into your 70s and things are going to slip. It just happens. I mean, you talked about physically. What about mentally?
Yes. And if you guys did not hear that podcast with Jonathan Fleece with Empath, go back and hit the rewind button on our podcast. It's a good one for getting kids involved or not involved, or getting you to think through these things when we get to this elder planning of life and what to prep ahead of time.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. We would love to have the opportunity to get to know you, to understand what you want in retirement. Maybe we can help. Sharice has been at this an awfully long time and has seen, the gambit, as we've said, from people who have a clean slate, have no idea. I just tell me what I need to do, and you do it, Sharice. Or the person who is really actively involved. You're going to fall somewhere in between there. Let us see if we can help. Here's our number. 833-368-3680. 833-368-3680. We'll do a free appointment with you. No obligation, no cost there. Let's just sit down and talk about what you want in retirement. You can also use our website, zinniawealth.com, ZINNIA wealth.com, and click on the gold box. You'll be on your way. All right, Sharice, you have a brother, but he's a younger brother, right? Mm-hmm. Okay. Did you ever get into fights with him in wrestling and he put you in a headlock?
Yeah, after I put him in headlocks. And then when he got stronger, I didn't get him in headlocks anymore. But yeah.
So the old thing was they put you in a headlock and then they'd give you noogies.
Yes.
Yeah, and then they'd say uncle. And you'd say uncle and they'd let you go, hopefully. Well, in retirement, we have another version of Uncle. That's Uncle Sam. And he has put a tight squeeze on your 401k. And you can yell Uncle all you want, but he ain't going to let go. Now, let's talk about being in our 70s. We talk about a lot being in our 60s. Let's talk about being in our 70s. There's a couple of ages here, 73, and then later on it's going to be 75. When Uncle Sam says to you, that big old fat 401k that you've been putting money in, I got to get paid on that now. And it's time for you to start taking your money out. And when that happens, some people aren't ready for it. They don't know what to do with that money. They find themselves in a tax problem. Do you have some stories of people who've come to you maybe for the first time, and this is why they came to you and said, Sharice, look at the size of this tax bill. I don't know what to do. Have you had those experiences?
Well, yeah. Let me just tell you something that's fresh on my mind. It's an experience that I've had with a long-term client of mine, actually, because the goal was to donate most of the IRA money to charities, and therefore he could every year the RMD could just go to the charity. They don't have to pay the taxes on it, and when they pass away, and if ever income they didn't need, it just moved, and then nobody had to pay tax on it. It was a beautiful thing. Okay. But all of a sudden, the goals changed, and they've been with me for about 8 years. And I've talked about rolling IRAs over to a Roth. I'm like, no, that's not what we're going to do because all this money is going to be donated. And all of a sudden, all this money is not going to be donated. And they do want it to go to some of their children. So something has changed. Maybe the children are talking to them now, or they're all getting along. Now they're seeing more grandkids. And so he's 72 years old. And he's like, Sharice, my 1.5 million IRA is $3 million, right? And now I have to get ready to take this RMD. I'm going to have to take close to $120,000 a year out of it. And I said, yeah. And he's like, why didn't I roll any IRAs to a Roth? And I chuckled. I'm like, you know why. And it's like, don't you put this on me. He's like, I'm not. He's like, but life has changed. And now I get Social Security and pension. My wife has Social Security. We're going to be over $200,000 in income because we're forced to pull this money out, because I was sure all this money was going to go to charities, and I was going to do qualified charitable distribution, so I didn't have to pay the taxes on the IRAs because I didn't really need it. And he's like, I don't want this money to go to charities now. I want it to go to my kids now, right? And if you had considered rolling IRAs over to Roth, we could have pulled from the Roth to give to the kids, right? So it's a hard place to be, because life does change, and sometimes you don't know what's going to happen. And so this is a scenario where we're in a rock and a hard place, because next year we're going to have to take an RMD. And I said, if you want to get more of that money, that $3 million out of that IRA, and roll it to a Roth, you first have to take your $105,000 RMD, pay the taxes on it, and you can give that to the kiddos if you want. But then anything remaining in that IRA you want to roll from IRA to Roth, you can. But then that just means you're going from $220,000 to $40,000 in income to, if you roll $100,000 a year for the next 10 years, to $300,000 and change. And so we're hitting higher tax brackets. And so people don't like that story. But, they're coming back in. We're going to do a tax plan to see, is it too late? Does it still make sense? And sometimes it is too late, but sometimes, just depending, sometimes the math can work out. And so we're working on that. I can't even give you the resolution to that yet. But it's sad, because I really wanted them to roll over sooner, and life changed for the good, right? And so that takes place. So the moral of the story, they're 72. Now, if you come into me and saw me at 62 to 65 and you had a similar story, and I might say, hey, in the meantime, why don't we roll over some IRAs to a Roth, because we don't know what life is going to be like in 10 years or what's going to happen, then it might be a good strategy. But if your money is intended for your surviving spouse and for your kids, and you're in your 50s and 60s, don't wait till 70 to consider rolling IRAs over to a Roth, because now's the time. We have an advantage in our tax season right now, right? Take advantage of what's happening because you never know what can change, right? Geopolitical risk. Taxes could go up. Things could be debunked. Things could be trumped, right?
I gotcha.
And so if it's about the legacy and a tax-free legacy and a tax-free income in the future, then we start working on it now. And we don't have to get crazy with it, but let us show you in our tax planning software what it looks like. What does it look like to roll $25,000 for the next 10 years out of your IRAs to a Roth IRA? What does it look like to roll $50,000 for the next 10 years? What does it look like to roll $100,000 a year over the next 5 years? Is it doable? Does it even make sense? And this is where we say we've saved people in taxes to their surviving spouse and their beneficiaries by doing this. But you're not going to believe it unless you see it on paper. So remember, we talk about 1 in 5 retirees get a written income plan. 0 in 5 retirees get a real tax plan like we're showing you. I mean, it's even a smaller number.
So that RMD money, and I know that we've dealt with this before, is people all of a sudden, they've got to get this money out of their IRA or their 401k. And they don't know what to do with it. And it just becomes a big old tax problem for them. So you've just talked about a couple of different things people can do. You can give the money to charity. You can do gifting, legacy planning.
If you're 70 and a half and older, you can give the money to charities and churches as long as they're 501c3, right? Up to a certain amount. It's a little over $100,000 a year.
What about planning for long-term care at that point? If you don't need that money, what if that becomes part of the pool, or building some insurance into some things like that, and that's your legacy plan? Maybe that's where some of the money goes.
Yeah. So they actually brought up to me, like, what about, so if I don't have enough time to roll these IRAs over to a Roth IRA, and it's just going to be a big tax burden. Their neighbor bought life insurance, and they said, why don't I just buy a life insurance policy to pay that tax bill for them so they keep 100% of the money? And I said, you can absolutely do that. It's going to come at a cost, but if you pay it for 10 years and we get the right type of plan, then it could very well work. But we got to do the math, because when you're 70, costs in life insurance go up. But we have seen it, and we have seen it work. We're not an office that's going to sit there and sell you life insurance. We hardly do it. But sometimes I've gotten a client in where they're like, we're going to spend a lot of our money. I want to buy a life insurance that's going to leave $1 million policy to my surviving spouse and my kiddos in case, there's longevity, and they want to spend all their money. And so sometimes people do that because it's important to leave a legacy, but they also want to spend their money, right? And so lots of rhymes and reasons. Some people, it's all about, I want to leave the biggest legacy to my kids. And if that's the case, and you've got $3 million, you want to pump that up to 10, then you buy life insurance to do that, right? So that's an easy thing to do. And some people buy life insurance policies so they can be their own bank. I don't even know legally if I can say that, but they have books out there like that.
I've heard of it.
So there are some advantages to that, by the way. I am not huge into doing that, but sometimes when we do the math, sometimes it actually kind of does make sense for a few people, depending on the goals and legacy and the taxes. And so life insurance also provides long-term care. So let's say you're 65 years old and you buy a $500,000 life insurance policy, and we get the right policy that has this long-term care builder in it. It allows you to accelerate 85% of that death benefit until it's exhausted, but you always got to keep a percentage of death benefit there per the IRS. And you could use that for your care, which is great.
That's a living benefit.
That's a living benefit versus buying a regular Genworth or John Hancock policy that raises its premiums. And a lot of time you don't use them, then you lose them. You paid all this money, where this life insurance policy, this is where I kind of like life insurance more as an overall package. Because this does work. Because if you don't use it, you don't lose it. Somebody's going to get that death benefit tax-free. It's going to be your spouse. And then your spouse, if they don't use it for long-term care, then your kiddos get it. And there are some insurance companies out there, and this is really my most favorite thing. It just makes the most sense to me. Like if you got an extra $50,000 or $100,000, you put a lump sum in there, and let's say you're 65, you put a $100,000 lump sum, you get a $400,000 long-term care benefit and a $250,000 death benefit in case you don't use it. I like that. That's money sense to me, just in case. And it depends on your age, right? There are a lot of things that it's dependent on. So,
well, we're all worried about long-term care, and this is an option there for you to discuss. And that's one of the reasons we have this show, is to just kind of, wet your whistle a little bit and say, here's what's out there. Yeah. And a lot of times people don't know what's out there. And we would like to introduce you to some of the solutions to some of these difficulties that we all are concerned about. Give Sharice a call. Let's talk through it. If you're coming up on that RMD age and that money's going to start coming out and you're going, it's just going to put me in a higher tax bracket, what do I do? Well, Sharice is giving you about 5 different ideas ideas here of what you can do.
Yeah, and I'll tell you something else. I've had early on in my career, people say, Sharice, I'm getting this RMD. I don't need it. I don't need any more investments in a market. And they take that RMD for the next 10 years and buy a 10-year life policy that left a huge legacy and or a long-term care policy. And then after 10 years and it's paid up, then you do have to figure out what to do with that money coming from your RMD. So there's a lot of things if you're in that boat. Some people are like, I don't have that problem, Sharice.
A lot of us have 401ks, and this is going to be something that we're going to have to be faced with as we get into our 70s. So let's talk through it. I mean, if you're in your 60s now, let's look down the line and say, okay, that could be a problem. Let's get some active solutions for it right now. 833-368-3680 is our number for a appointment with Sharice. There's no cost or obligation there. You can use our website, too. There's a gold box at zinniawealth.com. It says complimentary retirement consultation. You click on that, you'll be on your way. All right, so as we've been doing this show over the last couple of years, and we've been at this for quite a while here, as interest rates were going up, we told you about billions of dollars that were going into CDs and money markets. That totally makes sense.
Right.
As baby boomers continue to retire, they're looking for income. So we've told you about record numbers of annuities that has been sold, and that makes total sense. Well, today there's an article in the Wall Street Journal, and it says there are billions of dollars that are pouring into dividend-paying stocks. I can't come up with an answer why that, other than income. I can't come up with an answer for that, so I thought I'd throw it at you. Are you using dividend-paying stocks? Why do you see that there's an uptick in this?
Yeah, so that's one of our portfolio legs. That's just one of them. And there's an uptick in dividend stocks because when interest rates go down and you can only make 3.5% or even a lower amount, because when interest rates go down, those CDs are going to go down. You're going to be like, okay, I'm not making any money here. I need something that's going to make me more. A lot of people want to go to dividend stocks because if you get the hardy dividend stocks, you know, the Duke Electrics, the Abbeys, pharmaceutical company, you know, they pay, you know, on the higher end of 3% to mid 4% dividends every year. And remember, it's never guaranteed, but they're rather consistent, those types of companies, and people can see the growth in the company. It's a slower growth because they're giving you a match, basically is what I call it. They're giving you that free money, that dividend, and you can live on it and get that paycheck because a lot of people have these CDs in money markets and they're taking their returns or earning in them. They're using it as income. And so when the income isn't there, then people start to bob and weave and say, okay, I feel better about the stock market. So even in a dividend stock, one of the staples of the world, we're going to see growth over time, most likely, and we're going to get an income and we can live off of it. And so here's the deal in a dividend stock. Let's say you buy Duke Electric, and Duke Electric, I'm just giving you simple math, is at $50 a share and it pays a 4% dividend. Well, what if Duke Electric goes down from $50 to $40? Because that could happen, no problem. And it still pays, on average, close to that 4% dividend. So it's still paying you. You don't have to sell the stock, especially when it goes down, to get that income. You're going to continue to get that income. But remember, I have to say this compliance-wise, dividend stocks can change, meaning that 4% could go to 3.75. It can also go from 4% to 4.5. So it fluctuates. So you got to have this fluctuation and knowing, you know, where do you pull from if you do need that extra income in case you don't get that dividend that year or it goes down. And so people like that and they know that they can invest in the market and they feel comfortable about the market. But when, let's say you're not living on that income yet, and that stock goes down from $50 to $40, and they pay out that dividend, it's going to buy that stock at $40 a share. So you're getting more shares. That's about to pay you another 4% dividend, right? And think of that dividend as like your 401k. You contributed money, and they gave you a match, and that match was free to you. You just contributed to a certain amount, and they give that to you. Same thing with the stock. You put money in the stock. Now you have a share. Now they're going to pay you a dividend, and that dividend's going to buy another stock, you know, depending on the price and what it's paying, of course. So it's just a nice little thing to sprinkle in as one of the legs of your income streams, potentially, when it comes to your overall portfolio. And yeah, I think every single one of our clients have that dividend strategy. And if you have $1 million portfolio, you might only have 100,000 in there. Maybe you have 200,000 because we have other strategies built in to do other things at different times of market cycles.
But as you've mentioned, dividends can vary. You may find something that has 3%, and then you may find something else that has 7, 8, 9, 10%. Is there a red flag when you see a company that has a dividend of 7, 8, 9, 10%? Because that seems pretty big.
Yeah. So anything that's over, they say anything over 4.5% dividend payout is a riskier stock. So it's crazy because I just had a conversation and a longtime client of mine's like, Sharice, I really want this JP Morgan income fund. And I was like, okay, let's walk through it. I was like, let's go back to the last 5 years of this fund because it yields that dividend of 8%. And I'm like, just know that the higher the yield, typically it can be riskier. And I said, let's go back 5 years. And it was at $68 a share. And a year later, it was down to $54 a share. And the dividend changed. Then the next year, it went back up to 58 and reached back to 60. And the next year, it came back down. So it's bouncy. And it's sideways over the last 5 years. But it paid a dividend each year, different dividends. It wasn't always 8%, right? And so if you're living off that income and you don't care about the value of your account, then it's fair game. If you're not living off the dividend, and it's bouncy, sometimes that's okay too. So it depends what you're looking for because it's just going to buy more of that stock. And so there's a value there. And as long as you don't care about the bouncing around of the account value, then why not?
So I've heard the term aristocrat dividend or aristocrat companies and that kind of thing. So those are those almost like a blue chip stock, the long time kind of thing. Am I off base by saying that if somebody's offering 7, 8, 9, 10% on a dividend, they might be a young company that is looking to have people invest so that they have more money so that they can build their company, and that's the state that they're in, and the ones that have 2 and 3 and 4% might be the longer lasting companies that are more bigger. Established?
That's exactly the case.
Okay.
That is exactly the case. So younger companies are trying to raise capital. They're trying to get new investors to keep building and building and building. So they're going to pay you more. But what happens is sometimes companies don't prevail. Sometimes they shut the door. So then what happens? Sometimes they're just having hard times and they're trying to make the stockholders happy, but they can't. And the stockholders start getting out. Now they're hemorrhaging. So there's a lot of those ups and downs that you don't know about that's internal that's causing the fluctuation of dividends and maybe causing a company to go out of business. So you want to be careful. The higher the dividend, the more risk. Bottom line.
Gotcha. You're listening to Retirement Coffee Talk with Sharice Rivers. There's a lot of different places to put your money, and we got to evaluate each one, and is it right for you? And that's really what it is to have our complimentary retirement consultation. Build that portfolio that we talk about here on the radio. Give us a call. Give us a look on our website. Let's talk about what's right for you. Let's talk about what you feel and what you're concerned about and what you feel good about. It's so important to have the conversation right off the bat. 833-368-3680. Again, 833-368-3680. Give us a call. No obligation, no cost meeting. We call it a complimentary retirement consultation. That's a fancy term for a free meeting, okay? You could also find us online and go that way. It's zinniawealth.com, ZINNIA wealth.com. There's a gold box there. You click on that. You'll be on your way. All right, so as we get close to the Medicare window, we've been trying to put something on the radio show each week about Medicare. And you're probably getting stuff in the mail. You're probably getting emails because if you're 65, you're in Medicare, or maybe this is your first year to deal with this, there's a window that opens up. It goes between October the 15th and December the 7th. And right now you may have received something called an ANOC, which is an annual notice of change. And it's going to tell you what the costs are going to be next year for Part C and Part D. And in 2026, there are lots of stories that we're going to see some significant hikes in premiums and deductibles. So, Sharice, talk to me about your Medicare meetings that are coming up.
Yes. So there's Medicare Advantage plans out there. And you guys from October 15th to December 7th get to change your plans. And there's a ton of plans out there. And you're also going to get your ANOC, your annual notice, about your plan you're in today. I highly suggest this is the year you really investigate and look at your plan that you have and what it's going to, because you might not have had a premium for your HMO or PPO, and now you do. And, or maybe your hospital copay was $100 a day for 6 days, and now it's $300 a day for 10 days. Your prescription drugs, this is key. Please listen to this very loudly. I've seen big mistakes here. Most plans have a prescription drug plan included, right? You don't pay a premium for that prescription drug plan, but there's certain drugs that could be coming off the formulary. Make sure your drugs are on the formulary. If not, you might need to seek another plan that's covering that drug. Or maybe that plan took it from a generic to a preferred, and it went from $5 copay to a $50 copay. So you need to know that, because there are big changes happening this year, and you want to make sure that you don't get into January 1st and you're starting to use it. You're like, oh, that's not covered. Oh, that costs more. Oh, I got to figure out all this in my budget. Oh, it costs so much more. We're not going to be ordering pizza every Friday, right? That's just being sarcastic. But just know that changes are upon us, and they're making these Medicare Advantage plans cover more. Therefore, they're getting less. Therefore, they're going to charge you more. And so I am not a fan of a Medicare Advantage plan, you guys. I was the Medicare Advantage plan HMO PPO guru queen back in my day. And do you know the loops and the hoops I went through to get our clients covered for certain things that they should have been covered for, and they couldn't go to the Mayo Clinic when they had cancer where they really wanted to go, or certain things. And after 20 years of that, jumping through hoops with clients, I said, no more. My clients don't deserve to be treated the way they get treated in those Advantage plans. I want them to have a Medicare supplement, and I want them to pay the premium for the Medicare supplement, because you get to go anywhere you want as long as it's medically necessary and they accept Medicare. And to me, there was no hoops. You just went. And to me, there is a price to pay for free. And the price to pay wasn't worth it for so many people. I saw some daunting things happen. People having to change prescription drugs and then have to do prior authorizations and try a drug that they already knew that didn't work, but they had to try it anyways because the company said you had to do it. And then if it didn't work after 60 days, maybe we'd consider approving your drug. And what a headache. Come on, we're in retirement. That's the last thing you want to have to worry about. So I'm a fan of the supplements, but come in to see us. We'll coach you up about all the supplements. We'll coach you up about Medicare. What is an HMO? What is a PPO? What are some of the hoops you have to jump through? Because you're going to get lots of mailers and lots of calls about, hey, why my plan is the best. We're going to give you money back on your Part B. And that very well could be a good plan. But talk to us. I mean, we're gurus of this. This is what we do. Everybody on our staff understands it. And we're happy to help because it is very confusing. And we talk about how income planning and retirement planning is not complex. It's just strategic, and we just teach you how to do it. The most complex thing you're ever going to go through in retirement is that darn Medicare decision. Yeah, I am telling you. The engineers come in and see us because they're like, all right, can you spell this out for me? And that blows my mind because the engineer doesn't want to come see me to manage the money. They want to see us to help them with their Medicare. That's how complex it is.
Well, I bang your drum on the Medicare thing all the time because as you talk through this to me is just glaringly shows you how you need a local advisor. You can't be doing 1-800 financial help on this one because Charisse knows if you walk in the door and you say, I just got a diagnosis for diabetes. Okay, here's where you need to be. Here's where you need your treatment. And here's what plan you need to be in. Or you have some other kind of health difficulty. She has been in the front lines of this for so long. Yes. She can show you what you need and where you need treatment. And
some of you are super healthy. You're like, Charisse, if I could go with this plan and maybe pay a $30 premium or no premium or maybe like $50 versus a Medicare supplement that might charge you $120 or $150, you very well could go with those plans. We will absolutely refer you out to the Blue Cross representative or the Humana representative that we trust, make sure they're going to take care of you. And then maybe one day you realize, hey, I want that supplement, but there will be underwriting. Therefore, your costs, if you have ailments all of a sudden, could be higher than the average individual, right? So you have some decisions to make.
Well, the window is coming up on October the 15th. That's not far away. I encourage you to make your appointment with Charisse. And if this is only what you want to talk about. That's okay. And maybe this leads to other discussions about your finances and your retirement planning. Give us a call. Give us a look on the website. Here's the number, 833-368-3680. 833-368-3680. Or the website again, zinniawealth.com, ZINNIA wealth.com. There's a gold box on our website. It says complimentary retirement consultation. If you click on that, you'll be on your way. Sharice, that is all the time we have on this one. I'll give you the last word.
All right. If you haven't checked us out on social media, we're doing some fun stuff on there, and we're getting some YouTube stuff getting ready here in the next couple of weeks for education and learning. So check us out there. And here we have to say, and as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.